When it comes to planning for retirement, we tend to focus most of our attention on how to build up our 401ks, IRAs, and other retirement accounts. But sooner or later, all of us have to deal with another issue: how to turn the balances in those accounts into monthly income, a retirement paycheck, if you will, that will last for the rest of your life. Basically, there are three ways to go about it. The first is to manage it on your own. That is, invest in a diversified portfolio and draw enough each month to cover your expenses. Many advisors advocate the 4% rule. That is, you initially draw 4% of your portfolio's value and increase that draw by the inflation rate each year to maintain purchasing power. So if you had $500,000 in savings and inflation was running at 3% a year, you'd withdraw $20,000 the first year, $20,600 the second year, $21,220 the next year, and so on. By doing this, the odds are about 80% or so that your savings and income will last at least 30 years. To see how many years your retirement savings might reasonably last, you can check out the T. Rowe Price Retirement Income Calculator. But this approach isn't risk-free. For one thing, you may need more than 4% to live on comfortably. And even if you stick to the 4% rule, there's still about a 20% chance you could run out of money before you run out of time. And there's one more, less obvious risk. If your retirement investments perform well, limiting yourself to 4% a year could leave you with a huge pot of money late in life. That may not seem like a problem, but it would mean you live more frugally in retirement than you really had to. The second strategy is to buy an immediate annuity, an investment that will send you monthly checks as long as you live. Today, for example, a 65-year-old man who puts $500,000 into an immediate annuity would receive about $3,300 a month for life. The advantage? You don't have to worry about investing the money, and you're assured that your income will last as long as you do. You can find out how much monthly income you might receive from an immediate annuity, given your age and the amount of money you have to invest, by going to our Income for Life calculator. But there are downsides here as well. Once you turn over your savings to the insurance company for the annuity, you no longer have access to those funds for emergencies and such. And after time, inflation will erode the value of those payments. The third way to go, and the one that I think makes the most sense for many people, is to combine the two approaches I just mentioned. Put a portion of your money in an immediate annuity for assured income, and keep the rest in a diversified portfolio of stocks and bonds that you can draw on as needed. That way you'll have a cushion to fund unexpected expenses, plus the growth that a mix of stocks and bonds offers can help you maintain your long-term purchasing power in the face of inflation. How much should go into the annuity? There's no hard and fast rule, but one suggestion is to devote enough so that the annuity income plus Social Security and any pension payments can cover most of your basic living expenses. Whatever strategy you adopt, remember, life doesn't unfold with the predictability of a spreadsheet, so be prepared to make adjustments so you don't run through your savings too quickly and face a meager retirement, or end up with a big pile of cash and big regrets that you didn't enjoy retirement as much as you could have.